A man with options is a man with power. Author unknown. Wait, so I'm not buying the stock. I'm buying the right to buy or sell it? If you've ever stared at your trading app trying to decode what a call or put option actually means, you're not alone. And you're definitely not crazy. Let's be real. Options can feel like a whole new language. You've got delta, theta, strike prices, premiums, expiration dates, and suddenly your head is spinning. You want to take your trading to the next level, but every time you try to learn options, it feels like you're falling behind. Worse, maybe you've taken a few trades and lost money because you thought you understood what you were doing, until you didn't. The confusion leads to hesitation. The hesitation leads to missed opportunity. And before you know it, you're watching others grow while you're stuck on the sidelines wondering, what am I doing wrong? Well, breathe easy, because that confusion ends today. In this video, we're breaking it all the way down. No jargon, no overwhelm, just a clear step-by-step explanation of what options are, how they work, and why mastering them could completely shift the way you trade. Let's make it plain so you can finally trade with power, clarity, and confidence. So go ahead and comment, like, and subscribe, because today we're removing the mystery from options and unlocking your next level. Hey fam, I'm Dr. O, a trained psychotherapist turned full-time trader and the founder of the Trading Psychology for Reparations movement. I spent over 15 years serving in the mental health field, walking with people through trauma, stress, and transformation. But I realized something deeply powerful. So many of the wounds we carry in the Black community are tied to financial oppression, stolen opportunities, and generational limitations. And while we've been waiting on policies and politicians to pay us back, I decided it was time we took our power back through the stock market. Now I help Black traders understand that our wealth is not waiting on permission. It's waiting on mindset. It's waiting on healing. It's waiting on someone to show us that we are more than capable of navigating these markets and doing so with confidence, clarity, and community. My work is rooted in the belief that our reparations won't come wrapped in a check from the government. They'll come through knowledge, strategy, and psychological mastery. Through daily trading levels, market education, and a deep understanding of human behavior, I teach Black investors how to build wealth, not just for today, but for generations to come. I don't just teach charts, I teach courage. I teach clarity. I teach the emotional strength it takes to win in a game that was never designed for us to win, but where we now have the power to dominate. So if you're ready to change the story of your family, your finances, and your future, I want to invite you to walk this journey with me, because we are no longer begging for reparations. We're trading for them. And together we're building a movement of financially free, emotionally grounded, legacy-driven Black investors who know their worth and trade like it every single day. And in today's lessons, we're diving into options trading, what it is, how it works, and why it could be the missing piece in your wealth building journey. Whether you're brand new or just tired of being confused, this video is going to make options make sense. So before we get started, go ahead and comment, like, and subscribe, because the more we grow together, the more power we return to our communities. So let's get into it. Options trading is the practice of buying or selling contracts that give you the right but not the obligation to buy or sell a stock at a set price before a certain date. You're not buying the stock itself. You're buying the possibility of owning or selling it, depending on whether you choose a call option for buying or a put option for selling. Think of it like renting power. You get the benefit of movement in the stock price without needing the full upfront cost of ownership. It's flexibility. It's leverage. And when used wisely, it can create major opportunity with less capital. Now let's make it real. Remember Blockbuster? When you went in and rented a VHS tape, you didn't own the movie. You just paid a fee for the right to watch it for a limited time. If the movie was great, you enjoyed it, returned it, and maybe rented it again. If you missed the return deadline, there were consequences. Hello! Those late fees. Options work the same way. You're renting the right to buy or sell a stock for a period of time. You don't have to exercise that right, but it's yours to use before the expiration date. Options are the blockbuster rentals of the financial world. Isn't it wild that Netflix once pitched their idea to Blockbuster, and Blockbuster laughed them out of the room? They couldn't see the vision. They couldn't grasp the future. And now, Blockbuster is extinct, while Netflix is worth over $250 billion and stands as one of the most successful stocks in the market today. The lesson? Never let small-minded people make decisions about your big vision. When someone underestimates you, it's not a sign that you're wrong. It's a sign that they can't see what you're carrying. So let's continue, because it's time you learned these option strategies and prepared yourself for a legendary comeback against anyone who ever doubted your rise. Options trading was originally created for institutions and sophisticated investors who needed to hedge risks. Farmers, corporations, and fund managers used them to protect their portfolios or lock in pricing. Over time, the retail trading world caught on. And now, with platforms like Robinhood and Webull, the average person can use options to grow wealth strategically. But here's the key. Options weren't designed for gambling. They were designed for protection, for strategy, and for maximizing opportunities while minimizing exposure. If you're part of a community that's been historically shut out of wealth building conversations, this tool is one of the most powerful ways to flip the script. Because just like a Blockbuster, you didn't need to own the VHS to enjoy the benefit. You just needed access. And that's what options give us. Access. Access to large stocks. Access to wealth strategies. And access to a system that, when approached with education and discipline, can absolutely change the game. Stick with me and I'll walk you through how to do just that, step by step. There are two main types of options contracts every trader should know, and understanding them is crucial if you're curious about stepping into your power as an investor. These are call and put options. A call option is a type of options contracts that gives you the right but not the obligation to buy a stock at a specific price, known as the strike price, before a set expiration date. Think of it as a VIP pass. You don't have to use it, but if the opportunity becomes favorable, you can cash in. Traders buy call options when they believe a stock price will go up, allowing them to benefit from upward movement without needing the full capital to buy the actual stock. It's a powerful way to leverage limited funds for potentially unlimited growth. Here's an example. Imagine Apple is currently trading at $170. You purchase a call option with a strike price of $175, and over the next few days, the stock jumps to $185. You didn't need to buy the stock outright, just that option contract. Your contract now holds real value because you have the right to buy the stock at $175 while the market's offering $185. That price gap, that's your potential profit. And the best part, you did it with a fraction of the money it would have taken to buy 100 shares of the Apple stock. A put option is the opposite of a call. It gives you the right, but not the obligation, to sell a stock at the strike price before a set expiration date. This is your power move when you expect the market or a specific stock to drop. Buying a put option is like buying insurance. It protects your portfolio or gives you a way to make money even when prices are falling. For traders looking to profit in bear markets, put options are a crucial tool. Let's say Tesla is trading at $300, but you anticipate it will drop soon, maybe due to negative earnings or political tension. You buy a put option with a strike price of $290. A week later, Tesla falls to $270. Now you hold a contract that gives you the right to sell Tesla at $290, even though the market's only offering $270. That $20 per share difference is your advantage. In other words, you're capitalizing on the drop while others are watching their portfolios bleed. Put options aren't just about fear, they're about foresight and protecting your future. Now let's explore writing a call option, also known as a covered call. When you write a call option, you're agreeing to sell a stock at a certain price, also known as the strike price, if the buyer of the contract decides to exercise it. In return, you're paid a premium up front. Think of this as your income for offering that deal. Most traders use this strategy when they already own the stock, called a cover call, and believe it won't go much higher in the short term. It's a way to generate extra income on top of stock ownership, especially in sideways or slightly bullish markets. Here's how it works in real life. You own 100 shares of Apple at $160 and write a call option with a $170 strike price expiring in 2 weeks. You collect, say, $200 in premium. If Apple stays under $170, you keep your stock and the $200. If it rises above $170, you still profit, but your shares are sold at $170. It's a win-win either way, because you've monetized your stock in a way most people never even knew was possible. Writing a put option or a cash-secured put is different. When you write a put option, you're agreeing to buy a stock at a specific price, known as the strike price, if the buyer decides to exercise the contract. In return, you also receive a premium upfront. Traders use this strategy when they want to own a stock but only at a discounted price. So instead of waiting and hoping the stock drops, they sell a put and get paid to wait. If the stock never falls, they still keep the premium. If it does, they buy the stock they wanted anyway, just at a better deal. Example, you're interested in owning SPY, but not at $440. You write a cash-secured put with a $430 strike price and collect a $300 premium. If SPY drops below $430, you're assigned the shares just like you planned. If it doesn't drop, you keep the $300 and wait for the next opportunity. Writing puts allows you to act like the bank, getting paid to potentially buy stocks you already wanted. That's how smart money moves, strategically, with patience and purpose. Writing options turns you from a buyer of hope into the seller of strategy. It's a mindset shift that completely transforms your wealth journey. Now, while these next strategies are considered more advanced, don't let them intimidate you. You don't need to master them to become a successful trader. But if you're curious about taking your skills to the next level, These are powerful tools worth knowing about. So let's break them down one by one, not to overwhelm you, but to introduce you to what's possible when you keep growing and learning in this market. Number 1, the iron condor. The iron condor is for the calm before the storm, or better yet, no storm at all. This strategy profits when the market stays within a certain range. It combines a bull put spread with a bear call spread, selling both a call and a put while buying protection on either side. You profit from time delay and price stability, not from big moves. This is perfect for traders who believe a stock or ETF like SPY is going to chill, not sprint. Number 2, the straddle. The straddle is your strategy when you expect volatility, but you're not sure which way the price will go. You buy a call and a put at the same strike price and expiration. So if the stock makes a big move in either direction, you win. It's perfect around earnings announcements, Fed decisions, or major political news. Think of it as betting on movement, not direction. Then number 3 is the strangle. A cousin of the straddle is a more cost-effective way to play volatility. Instead of buying the call and put at the same strike price, you buy them out of the money, further apart. This lowers your premium cost, but you need a bigger move to profit. Great for when you expect a significant breakout but want to spend less up front. And then there's number 4, the butterfly spread. The butterfly is precision personified. You use this strategy when you expect a stock to land right near a target price by expiration. It involves 3 strike prices. You buy 1 call or put in the money, sell 2 at the money, and buy 1 out of the money. It limits both risks and reward, but when you nail the landing, it's beautiful and efficient. And then there's the calendar spread. The calendar spread is like planting seeds in 2 different seasons. You sell a short-term option and buy a longer-term option at the same strike price, banking on time delay to eat away at the short-term one faster. This strategy works best in low volatility environments and helps you capitalize on the passage of time. Traders use this when they expect movement later, not right away. Number 6 is a ratio spread. Ratio spreads are bold. You see more options than you buy, like selling 2 calls and buying 1. If done right, it allows you to collect more premium up front, but the risks become unlimited if the stock runs too far. This is a strategy for advanced traders who understand risk management and have a directional bias and a cap on potential movement. Finally, there's the diagonal spread. The diagonal spread is a beautiful blend of calendar and vertical spreads. You buy a longer-term option at 1 strike price and sell a shorter-term option at a different strike. It gives you flexibility in both time and direction, letting you express your unique view of where a stock is headed without committing to a single expiration or price level. So before you enter the world of options trading like a pro, there's one thing you've got to get familiar with: the Greeks. These aren't just letters from an old alphabet. In the world of trading, they are the DNA of your options contract. They measure how your trade will respond to price movement, time, and volatility. Mastering the Greeks gives you an emotional and strategic edge because you're not just guessing, you're calculating. Let's break them down one by one with relatable examples. Delta is all about direction. It tells you how much the price of your options will change if the underlying stock moves $1. So if your call option has a delta of 0.6 and the stock moves up $1, your option will increase by 60 cents. It's like knowing how strong your engine is when you press the gas. For example, if SPY goes from $440 to $441 and your call has a delta of 0.60, expect your premium to jump accordingly. Delta helps you ride with the trend instead of being tossed around by it. Gamma is the booster. It measures how fast your delta is changing. Think of it like acceleration in your car. A high gamma means your options delta is growing quickly, perfect for short-term traders. For example, if you own an at-the-money call on SPY and a big news event causes price to spike, your gamma increases, which means your delta will grow and so will your profits faster than before. Gamma is your clue that momentum is on your side. Theta is time decay. Every day that passes, your option loses value, especially if you're holding short-term contracts. Theta tells you how much you're losing per day just by holding. If your theta is negative 0.05, you're losing 5 cents per day on your option. That's like paying rent just to stay in the trade. For example, if you buy a weekly SPY call on Monday and don't sell it by Thursday, you may see your profit shrink, not because of a bad trade, but because of theta eating at your value like a clock ticking. Vega is volatility. It measures how much your options value will change with a 1% move in implied volatility. When the market gets jumpy, like during earnings or major news, Vega gets to work. If Vega is 0.10 and implied volatility jumps 5%, your option price rises by 50 cents. Imagine you own a Netflix call before an earnings announcement. If volatility spikes, even if the price barely moves, your options value can still rise. Vega is your friend when the market is buzzing with uncertainty. Rho is all about interest rates. While it's not as sexy as the others, it matters, especially in a changing economy. Rho tells you how sensitive your option is to 1% change in interest rates. If you're holding a long-term option like a LEAP and interest rates rise, a positive Rho helps you. For example, if your LEAP has a Rho of 0.20 and rates rise by 1%, your option gains 20 cents in value. Rho won't move the needle every day, but in long-term trades, it helps you understand the bigger macroeconomic picture. There are 3 more components of the options contract that we must explore: the strike price, the premium, and expiration date. The strike price is the agreed upon price at which the option holder can buy an in-call option or sell in a put option the underlying asset. Think of it as your target. It defines the battlefield for your trade. For example, if you buy a SPY call option with a strike price of $450, you're betting that SPY will rise above $450 before expiration. If it does, you're in the money and stand to profit. The strike price determines how close or how far your option is from the current market price, which affects both your risk and reward. The premium is the price you pay up front to own the option. It's the cost of the opportunity. The cost is based on several factors: how close the strike price is to the current price, which is the intrinsic value, time until expiration, and market volatility. For example, if SPY is trading at $445 and you buy a call option with a $450 strike price, the premium might be $1.25 per share or $125 total, since one contract equals 100 shares. That $125 is your investment, your risk. If the option expires worthless, you lose that premium. But if SPY rises above $451.25, you're now in profit territory. The expiration date is the deadline, the final day your option is valid. After this date, the option either gets exercised, sold, or expires worthless. The closer the expiration date, the faster your option loses time value, thanks to our friend Theta. For example, if you buy a SPY call expiring this Friday and today is Monday, you only have a few days for your prediction to play out. But if you buy one expiring next month, you give your trade more time to move. Traders choose expiration dates based on how fast they expect the price action to play out. Shorter time frames for quick trades, longer time frames for patient plays. Success in trading doesn't come from knowing everything. It comes from mastering what works for you. If you've built confidence using basic strategies like calls and puts, you're already further along than most. But maybe you've been watching other traders toss around terms like iron condor or butterfly spread and wondering if you're missing something. The truth is those advanced strategies are tools, not trophies. You don't need to master them all right now, but you deserve to know they exist and how they might serve you in your journey. These strategies, like the straddle, strangle, or calendar spread, are designed for specific market conditions. Think of them like power tools. You wouldn't use a chainsaw to cut paper, but if you're working with something bigger and bolder, it might be exactly what you need. That's how these strategies work. Once you know the market's personality, you can choose the strategy that fits, and that's how you begin to trade with precision, not just passion. But here's the beautiful truth. None of this learning has to be done alone. In our Trading Psychology for Reparations community, we walk with you daily. I send out free key levels to help you understand where the market is headed and how to align your trades accordingly. Whether you're just starting or scaling up, these levels can help ground your decisions with clarity, confidence, and community. The markets are wild, but you don't have to be out here trading blind. So if you're tired of feeling like you're missing out or just ready to grow with a community that sees your potential, join us. Get those free daily levels. Tap into a network of support, strategy, and soul. And don't forget to comment, like, and subscribe so we can keep this knowledge flowing and bring more of our people into a place of power, peace, and profit. You've got this. Peace and blessings, Dr. O.